All right. So I've got a minute after the hour, and it's Ron Crabtree here, Executive Advisor for the Next Level Purchasing Association. We're going to go ahead and get started. And I want to thank everybody who was able to join us and participate in today's webinar. And we've got a very interesting panel, mixed panel of expertise here. We're going to be addressing some interesting questions. In January, we ran a CPO 2022 Outlook Survey. We reached out to and connected with a bunch of folks in our personal networks. And we asked them a couple of open-ended questions. The second open-ended question was, what are the top 3 skills or abilities, areas of skill that your teams need to get better at to build on in 2022 and beyond? And to that question, 47% of the responses really rolled under this general category of supply strategy, risk management, change management, being the most important skill set across the board. And then inside of that, there were 11 buckets, right, that people were talking to. You can see those listed here. But these top 3 right here, flexible strategy, real-time decision-making, risk assessment, mitigation, and then how to manage complexity and find efficiencies in supply management. More than 50% of all the responses that we got inside of this were clustered very much around these 3 things. So surprise, surprise, that is the key part of our agenda for today's webinar. Each panelist is going to take one of those 3 key things in red and build that out for us. We're going to have Jim DeVries get us started and kind of start high, bigger picture from the Enterprise Risk Management Consortium. We're going to ask Eric Evans, take a deeper dive into what about risk assessment? What are the things available to us, best practices and technologies to help us get better at that part? And then Bill is, the purchasing officer, many years of experience, including a run at Gartner as a director in supply management research and what have you. I'll be sharing some gems for the practical. What do we go do, and how can we go after these issues with managing complexity and finding efficiencies? So with that, let's just take a moment here. Ask each of the panelists to unmute and introduce yourself. So Jim, if you could introduce yourself to the audience, please.
Thanks, Ron. It's an honor to be here with these esteemed guests. My background is as a resilient executive leader for a number of companies, from startups to Fortune 50 over the last 30 years. Of course, we've worked to identify, prioritize, and develop execution strategies for risk events and develop self-generating and self-funding results from those types of exercises. My main thing that I always look at from the people perspective is the people make the difference. It all starts with them, and we need to remove those barriers to help them fulfill their full potential.
Awesome. Good job. Eric.
Yeah, thanks, Ron. Thanks everyone for coming today, and appreciate being on the panel. And so I have over 20 years experience in data risk and compliance, and work at Rapid Ratings, where we do financial risk assessments. I've worked at Edgar Online and Donnelly Financial. I also co-chair the continuous monitoring working group over at Shared Assessments for vendor third-party risk. So happy to join today and talk to you more.
Awesome. Thank you so much. And not last but not least, Bill Antonens.
Yeah, good afternoon, everyone. Glad to be here. I'm Bill Antones. I have a background in end-to-end supply chain going back about 30 years now. A lot of that time was spent in the purchasing arena. And I'm glad to be joining today to share some of my insights and some of the things I learned along those 30 years along the way. And be looking forward to getting a lot of participation from the audience today. Thank you.
Awesome. Good job, everybody. Thank you so much. So we're going to start with a couple of polling questions, and I'm going to ask Adam to fire these up here in a minute, but we'd like to get a little demographic on the audience. We can get a sense for who's in the room with us today. So if you could fire that, we'd like to get a sense for which of these buckets best matches your role, your current role. So Adam, if you could fire that now, please. Make sure our technology is behaving.
Yep, will do.
All right. I can see the horse race has started, so I'll give everybody a chance to weigh in here. We have a high percentage of managers, supervisors, followed by senior procurement, supply chain executives. That's the exact kind of audience we're hoping to join us today, is what are some of the things we've gleaned, from the work we've done collectively as individuals and as a panel. So I've got some hands raised here, so I'll take a peek here, see if we can handle that while the poll is running. All right, we're getting pretty close to a quorum. All right, so I'm going to say we're close enough. We're going to end the poll so we can share the results, and we can see here that 44% of the audience was specifically manager, supervisor level folks, followed by 22%. So we have about 2/3 of the audience specifically in leadership roles in the procurement organizations, along with a high percentage of folks who are, the worker bees, if you will, and some consultants to industry. So thank you to everybody for joining us. We're going to now move on to the next polling question, and that's just get a bit of an industry demographic. So here again, of these choices, which one would probably be the closest fit? Probably not perfect, but if you could quickly fire that polling question, let's get a sense for the industries represented in our room today. Let's rock and roll. All right, so industrial products, automotive, banking is number 3 so far on the list. So gotta wait for a quorum though. Folks weighing in here. Life sciences, aerospace, consumer product goods, mining, oil and gas, service providers, and then other not listed. Well, that's not too big of a chunk, so that's good. And it's kind of hard to nail every possible industry, but the reason we picked these is these particular choices aligned with the community that participated in the survey earlier this year. So it seemed like a pretty good place to start. All right, so we're up at 40, getting there pretty close to more than 90% in there. So I'm gonna go ahead and end the poll and share the results. So you can see we've got a good cross section, right? Industrial products, it's pretty strong. Service providers, banking, automotive, life sciences, aerospace and defense, consumer packaged goods, fast moving consumer goods. That's a good cross-section representation. And for what it's worth, the findings and what we're going to be learning today from these panelists are industry agnostic. And some of these may apply a bit more to manufacturing, say to banking, and vice versa, but definitely this is not evergreen, certainly cutting edge, leading edge in terms of what's been going on the last couple of years and what we could or should be doing differently to make a difference in our organizations going forward. So I'm going to ask Jim to unmute here in a second, but we're going to ask the same basic 3 questions to the panelists, and they're going to tackle each of them in about 10 minutes. During that time, we will encourage you to ask questions. We'll watch for questions. We may pause and ask questions as we go, and then those we don't handle here, we'll get at the end for the wrap-up Q&A, but we may tackle some of the questions as we go, particularly if it's something that particular panelist that's speaking can help address. So what Jim's going to really get us at is when we think about that flexible strategy, real-time decision-making, demand and supply, that would kind of like that number 1 thing on that list of 3. What are the top 3 considerations? Why are those important? What should we go do? And what kind of impact might we get if we did that successfully? And then the most important part, what do we do? How do you do it? Well, give us those tips and insights that we can take immediately after this webinar and begin to put it into play in our organizations to make a difference. With that, we'll get Jim started here with this first slide.
Thanks, Ron. So just getting started, we just identified 3 or 4 things here that we're going to cover today. Supply strategy, creating that robust supply chain capabilities, and we have a readiness assessment, which says, where are you today? Where do you want to be? How are you relative to your industry from a benchmark? So it's more on a supply chain management perspective. Then we have a series of graphs that we'll go through. One is the maturity model, the 21st century maturity model on risk management. Where are you and where you're going from there from a risk management perspective, not just a supply chain management perspective. And then from a change management culture perspective, we'll look at the risk appetite and operational propensity, because how you view risk in your organization, and from an operational propensity perspective, what's the culture of your organization, which will tell you your speed. And then we'll go through a summary, high-level summary of some of the benefits of indoctrinating a supply chain risk management program from, as Ron mentioned at the beginning, the Supply Chain Risk Management Consortium has been doing this for over 12 years and has a lot of benchmark data with some what you should expect to see. With that, the next slide is what we endearly call our bicycle slide, which is linking strategy to execution and through tactics, which is the chain. So having something that links your strategy to execution and builds your overall cadence of your organization is absolutely vital for your organization to drive that dynamic decision-making to build that resilient sustainability. And so we look at it as those are two different worlds, and you need to connect those through the tactical. So we often hear in S&OP planning, your strategy, tactical, and operational levels. Just like that, we need to be doing that in this type of a program. So with that, the next slide. So we'll get into what we call our supply chain management readiness assessment. We have this both for manufacturing and services. And what we have is three major categories: strategic, tactical, and operational. The blue is strategic, the red is tactical, and the remaining are operational levels. And we assess where you're at today, where you're at, where would you like to be, where are you at versus best in class, and where are you versus your industry. And this is a free assessment that's available online where you can get your best in class ranking. So whether you use our system or you use the many different assessments out there, it's so important to have everybody trued up in your organization of exactly where you are today and where you're going. Without this, you end up do the whack-a-mole effect, as I call it, is you're focusing too much on operational, not enough on tactical, and you're not making any overall progress. And we also espouse people, process, data, technology. If your people aren't aligned, your processes aren't aligned, any technology you put in is not going to work. And everybody wants to do digital twins and these cool things, but if you don't have these core foundational foundations built, you're not going to get that extra, you won't be able to grow. And with that, I'll just go through the next slide, which is our supply chain risk and resiliency model that we've developed from best-in-class providers over the last 12 years. And we have, of course, foundational, that's where you're starting. Visibility, the visibility stage is, again, this end-to-end visibility, which is key. It's really your starting point. Foundational is all about, can you spell supply chain risk management? Do you understand what it is? Do you have a single language in your organization? Visibility is digitizing your supply chain, control tower, all those things that they teach in supply chain. We would like to see that. And then we're looking at it from a risk management perspective to build upon so we can become predictable, discrete event simulation type stuff. And then we get into resiliency and sustainability. Everybody wants to get to sustainability and resiliency, but it's a long path forward. So people ask, how long does it take to get through each level of maturity? Over the years, we've learned that it takes about 2 to 3 years to get through, depending on the size of the organization. And with that, we'll just move on to the next slide. The other perspective we look at in supply chain risk and resiliency as part of our 90-day action plan is we have on the y-axis risk averse versus risk opportunity. So does your organization look at risk as an opportunity, or is it something you shield against? The bottom left-hand quadrant are your pragmatists and conservators. It's just your environment of your culture of how you manage risk in your organization. So there's no right or wrong here. It's what you are. It's very hard to move from pragmatist to conservative to managers to maximizers. Maximizers are companies that are generally, they look at risk as an opportunity. Managers, they look at risk and they're trying to manage it. Conservators try to avoid it. Pragmatists completely avoid it. They wait till the last minute. So generally, companies that are more conservative, pre-2000 companies tend to be in the left-hand quadrant, bottom quadrant, and the post-2000 high-tech companies tend to be in the right quadrant, upper right quadrant. It's not 100%, but those are just things to look at. So anytime you're able to use risk as an opportunity, you're able to bring in a couple $1 million to your bottom line, no problem, and maybe even more money. And we'll talk about that a little bit later. And that brings us to the last graph, which is what we call the kite. What's the shape of your kite, we call it. And we have 4 different quadrants here that we look at. Bureaucratic, where the cursor is now, which is lots of layers of management. So if you have over 10 layers of management, you're probably in there. And the opposite of that is an agile company where everybody sits in a big room and there are no roles or responsibilities, so to speak. Everybody is there to make it happen. Of course, that's the extreme on agile. So there's many different versions of that, but they're, we think, polar opposites. And then trapped at the bottom, or clannish, is generally companies that are run by family businesses, old businesses, are typically in this arena. And then there's startup, where you're going as fast as you can, despite everything, in a like a JV, or you're trying to grow very fast. So these are all different types of environments. I'm showing a box kite. Generally, there's a long pole in the tent where you're maybe primarily bureaucratic, and then maybe a little bit of startup is often where you have an old company that's trying to do startup activities in another division. So you may have that type of situation. So again, there's no right or wrong, but this helps you decide at what speed you're going to go as you implement the maturity model that we talked about in the beginning. And our last slide here to round out this is the benefits of indoctrinating supply chain risk management. So there's many benefits. Of course, the typical is everybody wants to start with cost down, because that's what team seems to resonate. But you know, the companies that take on these, they will see insurance premiums go down. And especially in this world, we're going to start seeing insurance premiums go up because of course, COVID and what we call the W recovery. And we're going to see a lot of supply demand imbalances, and you want to keep those premiums down. So that's going to look a lot like a much better thing to focus on here soon than later. Automated workflow. Of course, you're going to be able to look at risk mitigation strategies to make sure that your workflow manages. So you can see, typically we see a 10% increase in flow there. Cost avoidance is the one that often you argue about with your finance people, and they say, is that real? Well, in today's world, it's going to be real, especially in an inflationary environment. This is going to become more and more important. And I think some of our other panelists are going to talk more about risk detection and assessment. Very, very important attribute. And cost avoidance. You can see those types of numbers. And then working capital is the next one. We see, 94% cash flow forecasting, an increase of 13% in free cash flow, because right now cash is king, especially in an inflationary environment that we're in now, where everybody's calling in notes. We're going to see that this is going to be even more important. So the supply chain risk and resiliency practices will help fantastically in this area, as well as your cash conversion cycle. So cash is king. You got to get your turns. You got to maintain your currents. Anything that's preventing you, you're identifying those risks that prevent you from being able to deliver. So if you live in a just JIT environment and you don't have redundancy, this is going to really affect you there. And then the last one that we mentioned here is the Altman Z store. And we're going to start seeing a lot of companies go under because they won't be able to handle this supply demand imbalance. And you understanding all the suppliers, a very cheap way to do it is the Altman Z stores. And I know that our panelists have even more complicated and better programs than Altman Z, but this is something that's free. You can do yourself, and then you can move to the better stuff with our guest panelists. So that's what I have.
Yeah, excuse me, Jim. So to be clear, the Altman Z score is a free resource anybody can take advantage of? Yeah,
you can look at Google Altman Z score. There's one for the public and private companies, and you can calculate it and by pulling up your supplier's information. If you're having a problem getting that information, you can require that from your supplier to make sure that they're solvent. So it's a solvency score, but you can do it for all I would do it for all your top suppliers that are most critical for you, especially if you feel like they're not able to deliver or there's some issues. You can also do it with your customers too, of course. Are they going to be able to pay your bills? So it's any company you can do it, and you can do it of your own company. How are you doing? So sometimes self-effacing is a good way to start.
All right, very good. So before we transition to Eric, let's just quickly check in. Any burning questions from the audience? If you have a question, there's the question tool, and you can do that. Or if you like to just use the chat tool, you could do that as well. But if you had a question that popped into your head, you can ask it now. We'll try to circle back to it, or we can hold questions for the end. So Jim, that was a very good job of taking us through that. And we're now going to pivot and move on to and have Eric come in. But here's what he's going to drill into, right? With respect to this pragmatic risk assessment and what we can do to mitigate issues so that we can ensure that our suppliers are capable, we're able to model risk. And this is going a little deeper now. We started pretty high. Jim took a big picture. Now we're going to go now a layer deeper, and then Bill's going to take us a little more deeper yet in terms of what's there and what we should be doing. So with that, I want to turn it over to you, Eric, to tackle what are the top 3 considerations? Why do we care? What should we do and what's the impact? And then give us some tips, some ideas of things the audience can take away
absolutely.
Right away.
Yeah, thanks. I think it's important to we kind of know where we've been, and but we'll kind of dive in a little bit just to set the stage. Obviously, we look at it in 3 parts at Rapid Ratings. Obviously, there were companies that had underlying weaknesses that existed before the spread of coronavirus, and obviously they got worse. Part 2 is kind of most companies struggled and needed immediate access to capital. And that's where, there were some cash infusions, right? During the height of the pandemic, credit lines, extended payment terms, government assistance here in the US, new lines of credits or investments. And now 3, now there's still weaknesses in supply chains, as we know, logistics, all over the place, different issues, rising interest rates. A lot of companies have had cheap access to capital, as Jim noted, and what we're seeing is that companies in this phase of the pandemic, some of their score short-term because they're building up cash, which is cash is king, but you have to really look under the hood because it's masking what could be happening long-term at that company. So if they've piled up some cash, their short-term score might look good, but their longer-term score still might look bad. And that's because they're kicking the can down the road with more corporate debt, right? And so this debt curve just illustrates, that companies are still borrowing, right? And, the access to cheap capital is, starting to dry up, but you can see that there's another debt bubble coming. So it's important to point this out. And so when we look at the next slide, we'll look at some supplier risks. Obviously, to your business, we'll dive into, obviously there's many risks today: sustainability, ESG, cyber risk, and then there's other things that companies are looking at. So
define ESG, please.
Yeah, environmental, social, governance.
Very good.
So the focus, tends to be on that sustainability side. There's a lot of laws in Europe, gas emissions and things like that, and protections and laws. And, the United States, obviously, with Biden taking over, kind of trying to get back into that swing of things. The point here is that, when companies are deteriorating, right, where might they cut some budget, right? And so they could cut payroll. They could cut, in our company's case, we're not going to cut down on our cyber hygiene, right? Because we're a SaaS company, and that's the first thing that clients want to know in InfoSec reviews. So if we don't want to cut cyber, are you going to cut quality and delivery? That could happen. Maybe you won't be as innovative. So then what happens, right? If the company's deteriorating financially, there may be quality and delivery issues. We did a correlation study a few years ago where companies that were weak financially were more than 2 times likely to ship a defective product and more than 2.5 times likely to ship late. So that whole just in time, really went out the window. And so really the message here is, obviously, if you're not financially solvent and not healthy, there's going to be issues and you might not bounce back and be as resilient. So really financial health underpins all of these kind of things. And so moving on to the next slide.
Yeah, before we do that, I have a question.
Yeah, sure. Absolutely.
When we talk about cyber risk, I always scratch my head. Because to me, there's 2 aspects to this. There's the cyber risk associated with, the bad guys attacking my company or my suppliers and impacting them.
Sure.
And their ability to perform. And then the other side of it is the products and services we create and sell to our customers. We have to design and develop products and services that are resilient and able to deal with. There's 2 pieces to this. And I'm just kind of curious, define cyber risk more fully, because I don't know if everybody in the audience has really thought about that carefully.
Yeah, it is twofold, right? So it's obviously understanding the impact of the companies you're doing business with, right? To make sure, are they going to be vulnerable, and are, what types of data, right? So there's all types of data in the relationship you're having with that company. Are they passing you, what's called PII data, personal information data, or not? And so, are things secure? Is that company going to get hacked? What's the impact? What kind of data is in their hands? And then from your perspective or our perspective, if you're a SaaS company or any type of company, but like exactly, making sure, are you going to get hacked, and is your data secure? In our case, we're handling private company financial statements. So, from our clients, where we're getting those financials from suppliers, their suppliers. And so we have to be very secure, and data security is first and foremost.
Okay, very good. Thank you.
Sure. And so when we look at our models, again, we talked about Holtman Z, that how well someone pays their bills may not predict the future. It's going to look kind of backward a little bit, and the historical is important, but we're looking, at the core health of a company, looking at 62 ratios. On top of this, we have 24 industry models. So every supplier or vendor or any company we rate, so to speak, we are identifying the industry they're in. And so 24 industry models really gets granular. And so first we will run a core health score, which is the medium-term score, about 18 to 36 months out. And that's a 1 to 100 score. And so you can get very poor health, very strong health. And then we layer in what we call these resilience indicators. And core health is also really looks at the capital structure, efficiency, cost structure, net profitability of that company. And so our inputs are always the financial statements, income statement, balance sheet, cash flow. It's easy to get the public companies, quite hard to get the private companies. And so, that's where we get the private companies' financials. And then we layer in these resilience indicators, which are more short-term in nature, the leverage, liquidity, earnings performance, to get what we call the FHR, the short-term score. And that really gives the probability of default in the percentage. And that looks, again, these are go-forward scores, a little more predictive. And since companies are not trending down, going bankrupt overnight, so to speak, they're trending down over a number of quarters or years using our methodology and models. And so, very, very different than, kind of a credit score too, because a credit score, any of us on the webinar today could have a FICO score, but if no one's looking at our assets and liabilities, we could be paying our bills just fine. But then if we lost cash flow, we could default on our mortgage or credit cards. And especially private companies are more volatile. They also tend to pay their bills on time to mask what's going on. And so the credit score isn't as meaningful. So if we look at a kind of a bisection of these models or output on the next slide, we'll look at the quadrant analysis, and that's where we'll look at the short term versus the longer term.
So I'm sorry to interrupt, Eric, but,
please.
the chat came in about what is the time horizon you're looking at? That just came in a minute ago. So I think they're trying to wrap their head around.
Oh, you mean in
the
terms of the
time
models?
interval. Yeah,
Mhm.
across these three, I think is what they're
So
fishing for.
so core health is looking at, like I said, that operating profitability, the capital structure, how well is the company managing their business, using these ratios, and that is a medium-term score of about 2 to 3 years out.
Okay, 2 to 3 years out. And then
and the resilience indicators are just how we kind of add the 11 ratios on top of the 62. So we get that really bakes into, it's an ingredient that goes into the FHR, which is 73 ratios. That FHR is the short-term score of roughly about a year, 12 months in short-term default risk.
All right.
And so, yeah, that gives you that short-term picture.
Thank you so much. Thank you.
Mm-hmm. Yeah, good question. And everyone loves quadrants. Don't go crazy reading small print. But so this just shows it's really important. That's why we have these two scores that we produce to show the intersection of the short-term score along with the medium-term viability or core health. And so it's really about the level and position, the velocity, right, and the rate of change and direction. So a company usually starts out in the upper right quadrant, quadrant A, and then it tends to go down to B and then over to C. And so when we kind of plot the scores out, you can take a number of the retail companies or any companies that are, really going bankrupt. It's that footprint over time where it's kind of this, downsloping curve into quadrant C. And you can see that over a number of quarters. And so again, unless there's, some fraud going on, it's easy to, from our perspective, predict, the deterioration. And so looking at the way these two intersect is important. And like I said, in this phase of the pandemic, we're noticing, like I said, a lot of these private companies have had access to, cash, whereas their medium-term score is still kind of deteriorating. And on to the next slide, we'll look at some tactics to implement, unless there's any questions. And so,
don't hang on, just let's check real quick. Okay.
Yeah.
Looks like we're okay on questions at the moment.
Great. And so in talking to our clients, what did they do during the pandemic and continue to do? And so they looked at and expanded their reach. If they were looking at direct vendors, they started to look at indirect, depending on their business. If they were looking at a slice of their criticals, they started looking at all their criticals. And then obviously it's about their vendor's vendor or their supplier's supplier. And so, coming up with these, other tactics and mitigation strategies. Again, if you've got a sole source, critical vendor, companies, as Jim said, they have these control towers, war rooms, and they're really trying to, find other sources so that they're not stuck with a supplier going down. The other thing is that they really reviewed the private company financial statements, which tend to be more volatile in tough times, right? They're not as scrutinized. They're a little more nimble. They can change quickly, but that could be a downside. And so they increased their review frequency. Sometimes companies are looking at financials annually or every, 12 to 18 months. They're starting to look at it, every 6 months or quarterly, depending on what's going on with that company. And so we even did stress testing where we took revenues down by 15% across the board, back in March, April 2020, before the statements were released. And then we took them down based on industry and earnings estimates, maybe 30% for transportation or airline industry and things like that. And so we also got pro formas from those private companies. And The other thing that companies are starting to do is invite their vendor or supplier and mandate, as Jim said, kind of, what's the word? Put in a mandate, have them commit to submitting their financials to them. And so we have an exchange where the supplier can come and join and upload their financials and self-rate themselves and then share their score on our network. Anyhow, you can also, one of the tactics that really has proven really well is leaning in by asking the right questions, right? Supplier collaboration.
Yeah, could you share a couple of examples? Asking what kinds of questions?
Yeah, actually, it's on a slide farther down. So we'll.
Oh, it is. Okay, we'll come back to that then.
Yeah,
okay,
but
cool.
really looking at the areas of concern. By running our models, and again, the industry model, we pull out the areas of concern, the key questions to ask. And that really allows a category manager or risk manager to lean in. And it doesn't have to be a punitive conversation. So we'll get into that in a few minutes. Again, working capital, as Jim pointed out, whether it's you're helping to reduce the vendor's days sales outstanding or days payable outstanding for yourself, adjusting those payment terms either to help yourself or help the supplier. And a lot of clients helped the supplier during this period. There were other tactics. They did spot buys on behalf of their vendors. Maybe they made a capital investment or they provided additional resources to the supplier, maybe by sending staff on site. So depending on that relationship, right, you use those questions, you look at the issues and you mitigate the risk by leaning in, and then that causes the direction you want to take. If you want to give them a bear hug, or do you need to move away from them quickly, if things are really unraveling quickly. So, and then I think the next slide we do have, the slide after that. But really the message is about building better relationships, stronger resilience, refreshing financial information consistently and at scale, understanding the analysis around the individual suppliers, benchmarking, right? Doing benchmarking on those suppliers in their peer group is huge and important. Operating those results into workflows, again, you want to have automation, APIs of different, whether you're looking at cyber ratings or financial ratings or sustainability. A lot of these risk rating companies like ourselves have APIs that can go into your GRC, vendor risk tool, supply chain risk monitoring control tower, and then really automate and facilitate workflows based on your risk tolerance. And then allowing those, really arming your front line to have better conversations, whether it's a financial conversation or a conversation around sustainability or cyber. And I think on the next slide, we've got those key questions. So awesome. I think we'll be sharing the deck, right, with everybody. And so obviously some of these things is, looking at, obviously you're intending to issue any equity in the next 12 months. What about long-term debt? What other financing? Is your funding principally from banks, bond market, or alternative credit providers? So really getting propeller head around some of the financial aspects. But looking at also, do you currently have the funds for the next 2 years of product investment? So again, how innovative are they going to be? So you can use these, the questions that are provided, plus, we have something, the financial dialogue that runs on every supplier. And so those pull out the questions relevant to them. But these are some of the standard questions we've seen for you to collaborate with your supplier on, and really around, financing and understanding their debt structure.
Very cool.
And who's backing them, especially venture or private equity. And I think finally, it's like, where are we heading the next 18 months? Obviously, if we had that crystal ball, and so looking at, obviously supply chain risk is embedded in. If you go to that next slide, Ron, I think we've got just a couple takeaways from my perspective. Obviously, supplier risk is not going anywhere. It's just how can you deal with it and really mitigate it. Financial health will only increase importance. You saw the debt scale slide. More private companies are starting to embrace, the value of transparency, and that, they're a partner, not just a vendor, and they want to collaborate. Obviously, COVID impacts aren't over. We've got rising interest rates, inflation, and so that's where the market dynamics will have a major impact on the suppliers you're dealing with and supply chain risk.
Awesome.
Thank you.
Good stuff. Wow. And that was jam-packed full. And I was trying to keep up with the chats and the questions as we went. Let's see here. Okay, great. So I think we were handling questions pretty well as we went. We're going to have some Q&A at the end, but now we get to have some fun and let Bill take a crack at this third thing, like with respects to the skills to manage complexity and find efficiencies. Same basic three questions. We're like the top three things we should go after and why. What we should do and what we can get out of that, and then the all important tactics, tips, and things we can go do. So with that, Bill gets the joy of coming behind two really great presentations and try to tie a little bow on this to some extent.
Okay, thank you, everyone. It's important that we had Jim and Eric go, because what I'm going to do is kind of play it from there forward. A lot of these assessments that Jim covered are very, very critical. I spent over 3 years at Gartner, and we did assessments after assessments after assessments, and a lot of risk mitigation exercises, as Eric pointed out. But once you get your ducks in a row and you really understand where your corporate strategy is and how is the supply chain strategy going to support the corporate strategy, and now what are we going to do about that, and what are some things to avoid, and what are some things you should be thinking about as you move the needle forward. Okay, with the next slide, please. So I'm going to talk about organization for a little bit. All right. So you heard Jim talk about, if we don't have the right people on the bus, we're not going to get any traction. Right. And not only do we have the right people on the bus, but are they actually contributing to where you want to go relative to your strategic plan and your tactical plans? So in this situation here, we had company X, Y, and Z. When I walked in, had a senior manager procurement and had a straight line of buyers under him, but they were all so deep into the woods that they really weren't getting anything done other than, executing purchase orders and receiving and put away in a warehouse and inventory management and things like that, right? But when I would talk to the manager and says, well, what are we doing to improve these things, to make them more efficient, to make them more meaningful to the company? The answer was, well, we're just too damn busy putting out fires every day and trying to get the day-to-day work done. So we took a big time out, and the senior manager of procurement and myself, we went to the C-suite and said, look, Mr. CEO, we need to spend some money on people here. We are not moving the needle. We are not making progress. We understand what the strategy is. Well, in this case, this was right after COVID took off. Demand was flying out of the window. We couldn't keep product on the shelf. We sold through, major retailers. So Walmart and Home Depot and Lowe's and all those guys were ordering anything that we could offer them, right? So things in the procurement space really needed to get tight, because for everything we shipped, it was a procurement tied to it. And so we started looking at category management functions where we broke these spends down into categories, and then we put buyers under them and some more analytical work around this, and really tied in the procurement team with our supply chain planning team, such as demand planning and supply planning, with our analytics team, so that we really put some KPIs around all this stuff so we could figure out where we're winning, where we're losing, and really got it rolling. We're happy to say that we ended up taking that original organization and we probably doubled the staff. But when you looked at the contributions, they were phenomenal. Next slide.
Yeah, before we go there, just so we can read this, so you had the original design of the organization and then the desired, right, where you were headed. So you've got a darker blue for new roles, like this category manager is a new role, right? New
Yeah.
role here, new role here, and then backfill. What do you mean by backfill?
Right.
What do you
Some
mean
of
by
them are
backfill?
back, some of them are new. You can see there
I
are a
see.
lot of new ones. When we talk about getting the right people on the bus, unfortunately, when I saw that survey at the beginning, probably 67% of the people on this seminar today are either managers or executives. So, sometimes we got to make some hard calls. Right? And when we ramp up the expectations, sometimes the hard calls are made for us, because you'll start seeing people jumping off the bus, right? Because of the expectation level is going up and up and up. So,
All right, thank you.
yeah.
I just wanted, I didn't know if that
a lot of
was, if that
new
was,
faces came in, and I think they're making, if I would talk to that senior manager today, the requirements that we had laid out are now being actually achieved.
okay,
Okay,
All
next slide.
thank you.
So we talked, you heard again, Jim, Eric both talked about doing some self-evaluation, right? Now, there's a lot of ways you could do it. You could do it internally, where you could go talk to your people and ask them, well, how are we doing? And what is our strategy? Do you understand where we want to go? And how are we, how are we getting there? Are we saving money? Are our suppliers in line? Do we have a good supply line? Or you can go to a consulting company, right? And they'll do it for you. They have elaborate tools where they get multiple functions to participate in these self-evaluations. And, you get different perspectives from different functional areas, whether it be operations or finance or the C-suite versus the supply chain staff themselves. So it's kind of like a little bit of self-reflection on, you think you're doing a good job, but everybody around you says you need to step it up a bit, right? So, think about where you are on process. So people, we started with people, right? Next is process. Are our processes, that we have good data coming in, the process within the box is oily smooth, and we got the results we want coming out, right? Take a hard look at that. And, I've listed a few things here. I'm not going to go through all of them in detail. You'll get a copy of this, but, we found, again, the number one thing, P2P, purchase to pay transactional load, and we broke it down by category, and we found out, well, in this certain category, there were 3 times more transactions than this category over here, but they have the same number of people processing the, the work. And I said, well, we gotta move some people around, right? And that's what we did. That's one. Obviously, building bench strength, right? What are you doing about filling the holes rather than, trying to always go to the outside? Are we building talent from within the company? Is there some intercompany movement going on where people can maybe move out of customer service or lower level jobs into supervisor roles or category managers, et cetera? So,
All right. So Bill, before we go to the next slide, there was a chat here. And it relates to the prior slide. How large of a company would the transformation structure be designed for?
In this case, the company was about 400 million in sales.
Okay, thank you.
Yep.
All right, awesome. On to the next slide.
And again, slide 2 on self-evaluation. I talked about category management, where you get some real experts in their category. They understand their suppliers. They've done supplier segmentation, right? They have segmented their key suppliers out. They talk to them on a frequent basis. Like Eric said, they're providing the information they need from a risk analysis and making sure if you got too many eggs in one basket, maybe, like we found that we had a couple suppliers that, we had 1 or 2 suppliers, but that represented 99% of the need. So we added a 3rd supplier and kind of more evenly divided it to spread the risk, right? Strategy development, you heard Jim talk about that. Obviously, scorecards and KPIs are awfully improved and important. Again, I could tell you horror stories going back 25 years ago where I walked into companies. I said, well, how you doing on perfect order, you know, on time and full? And they say, oh, we're great. We're doing a great job. I said, okay, we're going to start measuring that. And sure enough, you know, it came back at around 35% of their orders were on time and full, right? So they were giving themselves a lot of good pat on the backs, but the customers weren't getting what they wanted on time and full. And I want to really, you know, with the pandemic hit, what we found out, we had a lot of our suppliers that were offshore. Okay, so total cost of ownership, take a look at that. Don't look at unit price. Look at the total landed price from the point of origin to the point of use. And, you know, also, are there areas where you can move suppliers and reshore them, right? So rather than buying 93% of your stuff from China or Indonesia, why don't you kind of balance that geographically to reduce that risk, okay? And obviously data governance, many companies I've gone into, that is the devil is in the detail, right? Bad lead times, bad MRP data, bad supplier data, you name it, got to get it cleaned up. Next slide, please. So what do? The implementation plan. So again, pull out these assessments that Jim and Eric talked about. Do the assessments, be honest. Don't, you know, make it sound good. Be honest and ask other people to assess you. And have these consultants, if you want to bring them in, measure you against best in class companies that are in your industry. All right. I've said implementation plan to me is we got to manage each category. We do a gap inspection on the different categories of spend. Where are the opportunities? Do we have the right people? Do we have the right that? Category management is important, right? The more I can break down that spend and get a laser view with the, you know, a few good men or women working in that space and really understanding the risk and understanding the opportunities that are around us and cleaning up their data and all the things that I talked about goes a long way. And you know, start looking at other relationships, right? So we implemented something called integrated business planning when I was there, right? And integrated is basically advanced S&OP. It's S&OP on jet fuel, if you will. But it involves all the functions of the organization. You go through a 5-step process every month where you get with marketing and sales and you look at new product development, what's coming in your pipeline. You do your whole demand planning, working with sales and marketing, get them to own that forecast. You look at supply planning, where you got your purchasing people and your manufacturing people and your scheduling people and your warehouse people all in the room to make sure we can execute. And then we'd have an executive review with the C-suite. How did we do? What did we say we were going to do? Did we say what we were going to do? And if not, what are we doing to fix it? Right. So don't get isolated in a box in procurement. Procurement touches a lot of areas in the company, and you got to understand that, you know, how your customers view, you know, whether they work in IT or finance or operations or warehousing or wherever. Got to understand, are you adding value to them? That's
Awesome.
it. Thank you.
Good job. Awesome. And that takes us to our next polling question. And this is the one I really like to rub my hands together and see what we're going to get. And this is the opportunity for the audience to give us some feedback. You know, we had Jim talk about those three key things he was talking about. Eric, the 3 key areas he was drilling into, and finally Bill and the remaining 3 areas. So here's your opportunity to pick as many of these as you like and give our panelists a little feedback. What do you want to learn more about? You know, what would be interesting you to dig into? Because if we get a high hit here on some of these, we may circle back and build a deeper dive into some of these areas for future NLPA webinars. Okay, so with that, let's fire that polling question. Give the audience a chance to weigh in on, you know, what do you want to learn more about? So you'll have to scroll up and down, use the scroll bar to see all of them. And if you could go ahead and weigh in, you can pick as many as you like. And we'll just kind of watch the horse race here for a couple of minutes. There's a lot to think about here. So we got, wait for a quorum here. It's going to be another minute or two. Looks like we've got a pretty high hit rate on what Jim was talking about at the beginning, and pretty good high hit rate here on stuff Bill talked about toward the end, with a good mix in the middle here. So this is good stuff. And we're not limiting you, right? You can pick as many as you like, but we are interested in which of these caught people's fancy the most. So we have a little bit of direction around what we want to dig a little deeper into for future education opportunities for the NLPA community. All right, we're about 70%. I'm going to wait another moment here just to see if we can get something close to 90% participation would be good. So yeah, all of these topics are important. All right, we're at 75%. Just wait another 10 or 15 seconds here. Anybody else cares to weigh in? All right, we're going to end the poll and share the results. And as you can see here, we got hits on everything, and looks like, you know, pretty strong interest in this whole resiliency and how do you assess it, and then surprise, surprise, what do you go do? How do you go and actually implement and bring this home to the bottom line results we require? So thank you for the audience for participating in that. So with that, we're going to move into wrap up. We've got another webinar coming up, surprise, surprise, in next month, and we're gonna take that number 2 thing that the CPOs talked about as a skill area to be developed, and that was, what about supplier development, supplier management skills? That was the number 2 close follower, and we're going to have 3 different topics around that. You know, negotiation skills, new supplier identification, development, acquisition, and management skills, and then supplier relationship management, and all the aspects of that. So that's going to be a really fun webinar coming up, with Senior Vice President Supply Chain tackling one of those, one of our master instructors going to tackle one of the topics. And before I forget to mention, we're always looking for great panelists who have good stuff that would like to present or take one of these panelist slots. We're always looking for more panelists, more voices to include. So if you have an interest in being a panelist for a future NLPA webinar, please email me about that, and we'll handle it. Just a brief announcement. I mentioned this last month. NLPA has brought out a certification boot camp. So folks that are moving through the NLPA certification process, there's another layer of support to drive up, right, the percentage of successful pass rates to get through the examinations and also become certified. Because the fact is, certified professionals get better performance. That's just a fact. So that's the key thing. We're going to get them to that certification level. Just give you a little flavor for how this rolls out in terms of the process for the boot camp. So you can watch for some special lunch and learn type events coming up here in the next couple of months, where we're going to reach out to the NLPA community for a little deeper dive into how that works. Adam, can you talk about Learn It, Do It for a second?
Yes, thank you very much, Ron. A lot of very good information shared today, so appreciate everybody's time for going over everything. And NLPA's training and certification programs fit right in with everything that we discussed, and especially what Ron just mentioned a second ago. I've mentioned this on past webinars, but we have what we call our Learn It, Do It. And essentially what this is we can design and implement a training plan based on you and your company and your team's needs. So we do have our commercial off-the-shelf training. That's obviously a good option, but if you want something more specific to your company, your industry, then we can do that. And we can actually discuss all of the options to make that happen. I heard the word assessment mentioned a lot today. That's also something that we offer. That helps a lot of companies identify their key areas of opportunity. And we can do that by a team or by individuals, and then you can select training options from there. So whether you're a company looking for a team training or an individual that wants to progress through the other certification levels, if you haven't completed them, please take a second, email me. My email is listed right here at amerritt@nextlevelpurchasing.com, or you can put in the chat box to reach out to you, and I can certainly do that. But yeah, thank you very much. I appreciate everybody's time.
Good job, Adam. Thank you. Another announcement we made late last year is that NLPA now has the ability to provide interim talent solutions. So when you're struggling with some of these things and you need to backfill, but you're months away from a traditional hire and you need to get the work done, you can tap into this pool of NLPA resources if you need help thinking through what's our best strategy to really drive the right level of assessment and coming up with a plan. You could tap into people like Bill Antonins, as one of our presenters today, as a resource to help advise your company and how you might put some of that together as part of your team on an interim talent basis. So keep that in mind. If that's something of interest, you use the same number and email to reach out to Adam. All right, so we're going to pass by this polling question. If we had a little more time, we'd ask for some feedback on these kinds of topics for future learning priorities, but we're going to pass by that. I want to thank our audience for joining us today. We were able to get through our topics. We handled the questions as we went. I think there were lots of asks about, can we get a copy of the slides and whatnot? And of course you can. And so you'll want to come back to the NLP website after that's been posted and should be able to get your hands on a copy of this material. So I want to thank everybody for your precious time to have come out and joined us today. My thanks to Jim and Eric and Bill for the gems of wisdom you were able to share with this audience. And with that, I want to wish everybody fantastic success going forward, and we'll look forward to catching you at our next event. With that, thank you. Have a good day, what's left of it.
Thanks. Bye-bye.
Bye-bye. Thanks for coming.